So let's do a quick recap on our financial ratios. So I have some laws that will help out with the summary of our financial ratios. X margin is X over revenue. So if I ask you that was gross profit margin, that will be gross profit over revenue. If I ask that was net profit margin, that will be net profit over revenue. If I ask you that what is operating profit margin, that will be operating profit over revenue. Let's move to my second law of financial ratios. X turnover, that's revenue over X. So if I say what is asset turnover, asset turnover will obviously be revenue over assets. If I say receivables turnover, what is it? That will be revenue over receivables, and so on and so forth. But there are two exceptions to the rule. And what are the two exceptions to the rule? That will be payables, that's payables turnover, and inventory turnover. And why are they exceptions to the rule? Let's talk about it. Why are they exceptions to the rule? So here we have our suppliers. So this is the raw materials you got from your suppliers. We have work in progress and we have finished goods. Then we have our customers. So don't forget your company. This is your company, and the customers. What typically will link you and your companies together and your customers together. So you and your customers, it will most likely be account receivable. You and your suppliers, especially if they are not paying immediately, it will be account payables. Then between your raw materials to your finished goods, there is cost of sales or cost of goods sold. So account receivable turnover obviously would be sales or revenue over account receivables, because you must have sold something to your customers for it to be sales over revenue. But as far as your suppliers is concerned, you must have purchased something from your supplier. So that can never be sales over account payables. It will obviously be what? Purchases over account payables. So your account payables turnover will be purchases over account payables. Your inventory turnover would be what? It will be cost of goods sold over inventory. So please let's note that. So the two exceptions, that's this, inventory turnover and payables turnover. So moving on to my third law of financial ratio, X to Y, X per Y, or X on Y is the same thing as saying X over Y. So a typical example is earnings per share. This will be earnings available to ordinary shareholders all over weighted average number of shares. Debt to equity will be debt over equity. Return on equity, return is the same thing as earnings. That will be earnings over equity. Please don't forget that your earnings is the same thing as net income. So continue from the last slide. X cover is earnings just before X is being paid over X. As far as coverage ratios is concerned, there are two major coverage ratios: interest cover and fixed charge cover. Interest cover is EBIT over interest paid. EBIT is earnings before interest and tax. And fixed charge cover is lease payment plus EBIT all over lease payment plus interest paid. Let's start with interest cover. So as far as interest cover is concerned, let's look at our financial statement. I have an excerpt from a financial statement here. What do we have just before interest is being paid? What we have just before it is EBIT. So if it is EBIT we have just before it, then our interest cover will be what? EBIT over the interest paid. Then the next is fixed charge cover. As far as a company is concerned, generally speaking, companies will have two fixed charges: lease payments, more or less like rent and so on, and the second will be interest paid, interest payment. So for a company, there are two fixed charges. I can just simply call these fixed charges. So what of if you are looking at covering these fixed charges. What do you have just before the two fixed charges? So if you look at it, lease payment is somewhere here, and we can call this earnings before lease payment, interest, and tax. So what we have just before lease payment is earnings before lease payment, interest, and tax. So technically speaking, if you want to cover these fixed charges, what we can easily say is fixed charge coverage will be earnings before interest, tax, and lease payments all over the fixed charges. And we know the two fixed charges already. So to break this down, that's this here. That's our net income plus interest plus tax plus lease payments all over what? Our fixed charges. And our two fixed charges is lease payments plus interest paid. So this net income plus interest plus tax, we can collectively call it what? All of this we can call it EBIT. So EBIT plus lease payment divided by our two fixed charges will give us fixed charge cover. Moving on, X yield. Anything yield is over market price. So X yield is X over market price. Dividend yield is dividends paid over market price. Cash flow yield is cash flow over market price. Then it's also very important to note that items on the income statement, you do not have to find the average. You can use it directly. Why is that so? It is so because the income statement in itself is over a period of time. But items that you pick from the balance sheet, you need to find the average because the balance sheet is at a particular point in time. So you need to find the average. So if you notice previously, I talked about asset turnover, and we agreed that asset turnover is revenue over assets. So the revenue, you do not have to find the average because it's coming from where? It's coming from the income statement. So you can make use of that figure directly, but the asset, you have to find the average. So it will be average total asset. And why is that so? Because it is so because the balance sheet is at a particular point in time. But there are exceptions to the rule of finding average. And the exceptions to the rule of finding average is when you are dealing with liquidity ratios. We'll look at it in subsequent slide. Liquidity ratios, generally, you do not have to find the average, despite the fact that it is coming from the balance sheet. And the major reason behind it is because we're only interested in a snapshot. How liquid are you today? We are not interested in over a period of time. Today is what we're interested in. So if that is the case, then you do not need to find the average. Just make use of the snapshot figures and you move on.